Okay, class. So we have covered two parts of the series of Economy Prelims Booster, and we have attempted certain questions also. So we have learned about the most basic concepts of economy, uh, aggregates related to national income, and then today in this part, again we are going to pick up some important concepts, important from prelims point of view, and mainly this is about money supply. Okay, a very important concept from prelims point of view, and we are going to see certain questions also that have appeared from this section. Okay, so firstly you will have clarity over the concepts that are being discussed here, and then if you follow the discussion you will also have the confidence to attempt those kind of questions that UPSC is asking from these topics. Okay, so let us start. The first is, what is monetary policy? Okay, so monetary policy is nothing but a part of economic policy, and this policy is used by the central bank to actually control, or the more correct word is regulate, the money supply in the economy. And you have already studied about the concept of money supply. Okay, now if it is money supply which is getting regulated or controlled by monetary policy, then money supply is directly related to availability of credit in the economy. So the same thing is also used to regulate the availability of credit in the economy. So that is why it is written that the policy through which central bank uses instruments under its control to regulate the availability and cost of credit. Okay, so if credit is easily available, that means its cost is low. Yes. Okay, so it is through monetary policy only that the money supply in the economy is regulated, and money supply will also decide the availability of credit, the cost of credit also. Okay, so whether the money is available at higher cost, the loan is available at higher cost or low cost, that is also something that is going to be decided or determined by money supply. Because if there is increased in money supply, that means money will be abundant in the system, so that means credit will also be available at lower cost. Okay, so this is how this is related. Okay, let us see further. Objectives of monetary policy. Okay, so remember that monetary policy is regulating the money supply in the economy, and money supply will decide the demand in the economy. More will be the money supply, more will be the purchasing power of the people, and more will be the demand. Now, demand decides what? It decides uh, in what quantity people are going to purchase the item. So, for example, demand is more, that means that will be a good incentive for the producers. So, it is going to decide the production level, which decides the growth. Okay, so if there is demand in the economy, that will make it more attractive for the investment, and that is going to incentivize the producers to supply more. Okay, so in that sense, that is related to growth also. Now the same thing is also related to credit, that is the availability of loan. Okay, so through objectives of monetary policy, everything that is related to money supply, that is something that is going to be achieved. Okay, so the first is price stability, that means inflation. So if there is more or there is increase in money supply, that would mean what? Too much money is chasing too few goods. So that is called inflation. And that is why price stability also becomes one objective of monetary policy. Okay. So if prices are increasing, that means money supply is there is more liquidity in the system, and then there will be a need to suck out that extra liquidity from the system to stabilize the prices. Okay, then promotion of economic growth, I just explained you how this is related with money supply. Then the stability of financial system or financial sector, again it is related to price stability. Then all the factors that lead to growth, all the factors that regulate or that decide the availability of loan or credit in the economy, so that is related. Then the stability of exchange rate. Okay, and the most basic thing that you should know about exchange rate is this, that market exchange rate of Indian rupee vis-a-vis any other currency is decided by the two factors, that is demand and supply of rupee with vis-a-vis demand and supply of any other currency in question. So exchange rate is also going to be decided by money supply only. Okay, then promotion of employment. Okay, again, if it is money supply which is deciding the purchasing power, the demand, then to what extent producers are going to be incentivized to produce and investors are motivated to invest, all that will decide that to what extent the employment opportunities will be generated in the system or in the economy. Okay, so these becomes the objectives of monetary policy, and now you can relate it, that how this is related to the issue of money supply. Okay, monetary policy dilemma. Now you have to understand this thing very clearly. Okay, so what is dilemma? Dilemma means a problem where you have to choose one out of two options. Okay, so that is typically what we mean by dilemma. So what is monetary policy dilemma? Okay, understand it clearly, because this kind of conceptual clarity required in this topic. So when it comes to monetary policy dilemma, you just came to know about the objectives of monetary policy: price stability, then promotion of growth. So dilemma is actually related to these two things only: the trade-off that exists between price stability and economic growth. Okay, why I'm saying that there is a dilemma? I'm saying that this is a dilemma because if central bank tries to promote one thing, that is tries to stabilize the prices, then it has to decrease the money supply in the system, and that is also going to decrease the purchasing power, that means the demand in the economy. Okay, that will de-incentivize the producers to supply the products in the market. That means there will be reduction in production, or production will reduce or decline. Then economic growth will also decline. Okay, let us understand this thing through a graph. Okay, so I trying to show it graphically. On x-axis I'm putting national expenditure, or here you can also put quantity of commodities supplied and demanded. Okay, and one on y-axis I'm putting the price. Now if I draw the curve which represents the total demand in the economy, I can call it aggregate demand in the economy, then demand curve will be like this. Yes, demand curve will be like this. Okay, so demand curve is have downward slope. Okay, because it has inverse relations. In that sense, quantity demanded has inverse relation with price, and whenever the relation is inverse, the slope is downward. Okay, and if I want to draw the supply curve, the total supply in the economy, that can be called aggregate supply, then I can draw it like this. Okay, so here you can see that the supply curve, the curve of aggregate supply, has upward slope because it has a direct relationship. The quantity supplied has a direct relations with price. So whenever there is direct relationship, the upward slope graph is something that you get. Okay, now what I'm trying to say, understand now. I'm saying that if central bank wants to promote growth in the economy, okay, so if central bank is trying to promote economic growth, then what it will do, it will increase the money supply in the economy. That increased money supply will increase the purchasing power of the people. You, me, and everyone will be having more money in their pocket to purchase or to demand more things in the market. So in that sense, the economy as a whole will witness increased demand. And when there is increase in demand, you know that demand curve shifts rightward. So this will be the new demand curve. I can call it AD1. Okay, this will be the new demand curve. So quantity demanded will increase, and that is going to increase the production. And increase in production is something that you call economic growth. Yes, economic growth in most simple terms can be defined as increase in production. Okay, consistent increase in production. While economic development, I will just remind you, is not just increase in production, it is that kind of economic growth which also entails increased standard of living. Okay, so here we are concerned about economic growth. The central bank is concerned about economic growth. So it will focus on increasing the money supply in the economy, and that increased money supply will increase the purchasing power of the people, and people will be demanding more in the market. Okay, so aggregate demand increases. That itself shows that there will be more production. Okay, more production here. So you understand, when aggregate demand increases, aggregate supply or the quantity supplied has also increased from here to here. Okay, so you can see that. But at the same time, what is happening? Understand, earlier the price level was this P, but now in the new equilibrium, the price has also increased. Okay, so this is the new price. Earlier the price was this, and now this is the new price, and there has been increase in price because of increase in aggregate demand. Okay, so if central bank is trying to promote economic growth, then it may lead to inflation, or in most occasions it will lead to inflation. Okay, so price stability means what? We have to contain inflation. Okay, so if central bank tries to promote economic growth, that is leading to a situation of inflation. Now if central bank tries to stabilize the prices, that it wants to bring down the level of inflation, that it wants to bring down the level of average price level in the economy, then that is going to reduce, or that can be done only by reducing or decreasing the aggregate demand in the economy, by decreasing the purchasing power of the people. Okay, now that will decrease the growth also. So this is what is being referred as dilemma, that central bank cannot target both simultaneously, that is price stability as well as economic growth. So it will have to choose one over the other. Okay, so for example, nowadays you are reading in newspapers that central bank is trying to target inflation. Okay, so actually there has been inflation around the globe, and central bank of not only India but around the globe have been trying to contain inflation. So the attempt of central bank is that it does not happen only at the cost of economic growth. Okay, but that is not possible. To good extent, that will be compromised if central bank is trying to contain inflation. Okay, because it has to decrease the aggregate demand economy, that is purchasing power. Okay, let us come back to the topic here, that is monetary policy dilemma. This is the trade-off that exists between price stability and economic growth. Okay, so if central bank tries to promote economic growth, then that is inflationary. Okay, that can lead to the situation of inflation. But if central bank tries to stabilize the prices, that is bring down the level of inflation, then economic growth is compromised. It can decrease. Okay, this is what we know as monetary policy dilemma. Okay, now attempt the question. This appeared in the year 2011. Okay, so question, economic growth is usually coupled with, see, we haven't completed the topic inflation as such. I'm going to deal with that topic in the next part in detail, because that is very, very important topic from prelims point of view, and this is in nowadays news also, okay. So just by the common understanding of the monetary policy dilemma that we just developed, we can attempt these questions. Okay, so economic growth is usually coupled with, So just recall the graph that we discussed here. When central bank was trying to promote economic growth, what was happening? Price level was also increasing. So this way you can attempt it, that an increase in price level is called inflation. I told you. So now attempt this question. Economic growth is usually coupled with deflation. No. Inflation. Yes, inflation. Stagflation is what? Inflation plus unemployment plus recession. So that is called stagflation. That is something that we are going to cover. But directly, most directly, you can answer this question that yes, economic growth is usually coupled with inflation. Okay? So B is the correct option. We don't have to look beyond that, but it is advisable to always check all the four alternatives before encircling any particular option in your OMR sheet. Okay? So I hope you will keep that in mind. You are going to study about deflation also in the inflation chapter. Okay, so there are three terms: inflation, then disinflation, then deflation. So there is a slight difference between disinflation and deflation. That is something that we are going to understand in the very next part. Okay, so the answer to this question is inflation. Even when you are not aware of other options, just by the common understanding that you developed of a monetary policy dilemma, I hope you can answer this question now. Okay, and the similar question that UPSC can raise. Let us see this question. This appeared in the year 2013. A rise in general level of prices may be caused by general level of rise in general level of prices is called inflation. Okay, inflation. So inflation may be caused by an increase in the money supply. An increase in the money supply. Yes, it can be caused by an increase in the money supply. A decrease in the aggregate level of output. A decrease in the aggregate level of output. So I think the first statement, that is an increase in the money supply, you can directly relate it with the concept of money supply that you understood, that if there is increase in money supply, that is going to increase the purchasing power, and this purchasing power is going to increase the demand, and that is going to increase the price level. What about the second option? That is a decrease in aggregate level of output. Aggregate level of output means what? Supply. Okay. So let us recall this curve that we studied about and analyze this option. Okay. So I think you can pause the video and can do it on your own if you want to, because we just learned about it. This was the aggregate demand curve, and this is the aggregate supply curve. Okay. Now, whenever there is increase in aggregate demand, then the demand curve shifts rightward. And whenever there is decrease in aggregate demand, then demand curve is going to shift leftward. Similarly, whenever there is increase in aggregate supply, then aggregate supply curve is going to shift rightward. And if there is decrease in aggregate supply, then aggregate supply is going to shift leftward. So in the question, decrease in output, that is the second option that we are going to analyze here. Decrease in output would mean decrease in supply. So decrease in supply would mean what? That the supply curve is going to shift leftward. Okay. So this curve is going to shift thisward, leftward, and now we can get the new supply curve here like this. So this is going to be the new supply curve. I can call it AS1. Okay. Now understand that in the previous case at equilibrium, this was the price level. This was the price level. Yes, P. And when we got the new supply curve, this became the point of equilibrium. This is the point of intersection of demand and supply curve, and this is the price, P1. So what you see here? Increase in price level. Increase in price level. Okay, you just have to remember this rule that whenever there is increase in supply curve, increase in supply, then the aggregate supply curve is going to shift rightward. Whenever there is decrease in supply, then aggregate supply curve is going to shift left over. Similar will be the case with aggregate demand curve also. So you just saw that if there is decrease in output, that means decrease in supply, then aggregate supply curve is going to shift leftward. Then the point of intersection will be from this to this, and here you can see that the price has increased. Okay, so let us analyze the second option now. A decrease in the aggregate level of output. Yes, this is leading to increase in the prices. So that will also become a factor behind rise in general level of prices. Okay, now that is something that you have analyzed technically by drawing the graph, but just by common understanding, if supply, or you can say output, is decreasing, that means what? If output is decreasing, then there will be increase in the prices. Now the demand of any particular product in quantity terms is 100. Now only 50 such products are available in the market. Then that means output has decreased, and now instead of 100, 50 products are available in the market. Definitely the prices of that 50 products will increase. Okay, so with the decrease in supply, there will be increase in the general price level. So this option is also correct. Yes, this will also lead to rise in general level of prices. An increase in effective demand. Now this is directly related with increase in money supply. You just understood that increase in money supply is going to increase the demand, that is the purchasing power in the economy, and increase in demand increases the price level. So this will also lead to rise in general level of prices. Okay, so what about the answer? Which of the statements given above are correct? First is also correct, second is also correct, third is also correct. So this way, this becomes the answer. Option D is the answer here. Okay, so let us see. Let us see this question now. This appeared in the year 2014. Okay, if the interest rate is decreased in an economy, interest rate means the rate at which loan will be available, the credit, the cost of credit. Cost of credit means that is something that is going to be decided by interest rate. Okay, so if interest rate is decreasing, that means cost of credit is also decreasing. That means MS, that is money supply, cost of credit is decreasing, means now loan will be available at lower cost. Now if loan is available at lower cost, then that is going to increase the money supply. Okay, increase the money supply. So this is how you have to connect. Now let us see, if the interest rate is decreasing, that means money supply is going to increase. It will decrease the consumption expenditure in the economy. Now if there is an increase in money supply, don't you think that the consumption expenditure will increase? So that is not going to be the option. Increase the tax collection of the government. Now this is in no way directly related with the increase in money supply. So this may or may not happen. Okay, so for example, if there is increase in money supply, then interest rates will be lower, then there will be greater chances of investment. Now that means greater production, that means greater excise duty, then greater tax collection. But it may also happen that this chain is not followed. Okay, so this may or may not happen, so we can't go with this. We can't be certain about option B. Increase the investment expenditure in the economy. Definitely, if credit is available at lower cost, then banks will be able to lend that money at lower cost. That means investment in infrastructure in the economy, that is going to be facilitated. Okay, so this is going to motivate the investors in the economy to invest. Okay, so it will be easier to invest because there is low cost of credit. So this is directly related with increase in money supply. Okay, increase in money supply, or this is directly related with decrease in the cost of credit. Okay, decrease in the cost of credit. So this is the most correct alternative among A, B, C. Let us see, let us analyze. Never forget, in UPSC you have to analyze all the four alternatives. The question you must remember is not about this statement. Question starts from here and just before the next question actually appears. So this is the complete question. You have to keep in mind when you are going to attempt prelims this year, you have to keep in mind that you must have to study, read every single sentence that of the question. Okay, so that is the most important thing. Keep in mind. The fourth is increase the total savings in the economy. Now, savings is a function of income, but that is something which is not directly related with the cost of credit. Okay, so this is also not directly related. This may or may not happen with just decrease in the cost of credit. So this way we can arrive at a conclusion that C is the correct alternative here. Okay, so you just saw that just by understanding the economic concepts in most clear terms, it becomes very easy to answer the questions in UPSC prelims examination. Okay, let us see further. Now, monetary policy instruments. Okay, so you know that how through monetary policy, mainly it is about regulation of money supply in the economy. Now, what are going to be the tools employed by the authority to increase or decrease the money supply in the economy? That is something that we are going to study. So two kinds of tool. The first is quantitative, the other is qualitative. Quantitative tools, or you can say they are general tools. General in the sense that they are going to increase or decrease the money supply of the system as a whole. Okay, so they are going to have an effect on the system as a whole, while when it comes to qualitative measures, they are specific measures. Is specific in the sense that they are going to be concerned about transferring of funds from one sector to another, okay, or making the credit available to at lower cost for any particular sector of the economy. So these quantitative measures are general measures, general in nature. These are specific in nature, specific with respect to the sector any particular measure is targeting. Okay, so these are two kinds of measures of when it comes to monetary policy instruments. Let us see first quantitative measures. Quantitative measures. The first such quantitative measure is cash reserve ratio. Cash reserve ratio. Okay, CRR. Now, what is CRR? The percentage of total public deposits. In the previous part, we have come to know that is what is total public deposits. It was also called net demand and time liabilities, which was different from total demand and time liabilities. Okay, so total public deposits is different from total deposits. For clarity, you can see the previous part here again if you have forgotten. Okay, so what we excluded from total deposits to get total public deposits, we excluded interbank deposits. So what we excluded to get NDTL from TDTL, that is total demand and time liabilities, we excluded interbank deposits to get net demand and time liabilities from total demand and time liabilities. Okay, so it is the percentage of NDTL, that is total public deposits, which banks have to keep with RBI at any time. At any time. Okay. So for example, there is SBI Bank, and its total net demand and time liability is 100 rupee. 100 rupee. Okay. Now, if CRR is, let us consider it to be 4%, that means 4% of NDTL, in our case it is 100 rupee, is to be kept aside by SBI with RBI in form of cash. So that is something that also you have to remember. Okay, so that 4 rupees, that is 4% of 100, that is NDTL, is not available with SBI for lending. Okay, so that is the purpose here. So that is something which has to be kept aside and kept with RBI. SBI is going to keep this 4 rupee with RBI in form of cash. And also remember, SBI is not going to earn interest on it. Okay? SBI is not going to earn interest on it. So now, if CRR is 4%, that means 4% of 100, that means 4 rupee is going to be not going to be available with SBI for lending. So now, how much SBI can lend? 100 minus 4, that is 96. Okay, so that 4 rupee SBI has to keep with RBI. Getting it? So the very concept of CRR or CRR itself, don't you think is going to decrease the amount that banks have with them for lending? Yes. So earlier NDTL was 100. That means this much was actually available with bank for lending. But now CRR is 4%. That means 4 rupee has to be kept aside with RBI by SBI, and now that 4 rupee is not available for lending. Okay, now understand that if there is increase in CRR and CRR from 4% becomes 10%, that means now SBI has to keep 10% of 100 rupee, that is 10 rupee, aside with RBI, and that will not be used by SBI for lending. So I ask you that if CRR is increased, then what is the effect on money supply? And what is the effect on small m, that is money multiplier? Increase in CRR is going to affect the credit creation capacity of the banks. Yes, it is going to affect it positively or negatively. That is the question. Okay. So money multiplier here, that is a small m, I have already taught you about this small m, is going to increase or decrease. Whether it is going to increase the credit creation capacity of the banks or it is going to decrease it. That is something that you have to answer. So I think you will be able to conclude that increase in CRR by the understanding that you have developed if you have seen the previous parts also. Increase in CRR is going to decrease the credit creation capacity of the banks, because they have to put the greater amount or the greater proportion of their NDTL aside with RBI, and that is something that they will not be able to lend. So increase in that amount is going to decrease their credit creation capacity. That is, small m is going to decrease, and that is going to decrease the money supply in the economy. That is going to decrease the money supply in the economy. Now, decrease in money supply in the economy is going to decrease the aggregate demand. Okay, is going to decrease the aggregate demand. That is going to decrease the inflation. That is going to decrease the inflation, but economic growth will also come down. Economic growth will also come down. Yes. So this is the link that you have to remember. Okay, there have been questions, or there can be question again on these kind of links. Okay, so CR in that sense is very important. So if there is decrease in CRR, that means credit creation capacity of the banks will increase, and that is going to increase the money supply, will increase the aggregate demand, will promote the economic growth, but may also lead to inflation. Okay, so that can be inflationary. So that is the link that you have to remember. Now these are the trivia. That is, earlier this was the limit, now this is the limit. So 3 to 15% was the limit earlier, now it is 0 to 100%. So the amendment that was carried out in the year 2006, RBI is now empowered to keep the CRR 100% also, or 0% also. Okay. Now the next is statutory liquidity ratio, and even when you understand it, my suggestion is to follow the discussion that I'm going to have here on SLR, because this is really important. Okay, really important, and most probably you will not be able to you might not be able to I might not be knowing all the things that is going to be discussed. Okay, very important. So very important discussion on SLR now. Okay, you just studied about CRR, and that is the percentage of NDTL that banks have to keep with RBI. Okay, now what is SLR? Percentage of total public deposits. Total public deposits means NDTL, yes, net demand and time liabilities, which banks have to maintain with themselves. With themselves. So CRR was to be kept with RBI, while SLR, that is something that the banks have to keep with themselves in form of specified liquid assets. Now, here the things become very important. Okay, this concept becomes very important. In form of a specified liquid asset would mean that there are certain specified liquid assets. For example, gold, cash, and government security. Okay, gold, cash, and government security. Now, let us say SLR is 18%. Okay, and again, let us consider that SBI is the bank whose total public deposit, that is net demand and time liability, is 100 rupees. Okay, that means 18% of NDTL, that is total public deposits, SBI has to keep with itself. That means 18% of 100 rupees, that is 18 rupees, in form of cash, gold, and government securities. Cash, gold, and government securities. That has to be kept with itself all the time. That has to be maintained all the time. Okay. Now that means this is something that SBI will not be able to use. This amount of money SBI will not be able to use for lending. Okay, that will not be available for lending. Okay. Now, I will ask you that if you are SBI bank, then if it is allowed to hold this 18 rupees in form of cash, gold, and government security, you would prefer which kind of liquid asset? You will prefer cash or gold or government security, but it has to be maintained. So you will prefer which particular liquid uh, asset the most? Now, that is something that you have to answer. You can think on it, you can pause the video, and then I will tell you. So, you have to choose between cash, gold, and GSEC. Getting it? Now, one might be tempted to choose cash because this is the most liquid asset, can be readily used because this is the most readily available money. But don't you think that if 18 rupees is being kept or SLR requirement is being maintained in form of cash alone, then cash is not going to generate you any interest. Okay? So, and there is opportunity cost involved here. That means banks will not be able to use that much of cash for any other purpose. So, opportunity cost is also involved. Okay? At the same time, cash is not going to cash in SBI's vault is not going to generate any particular interest. Okay. Now, one may also think that SBI can prefer gold or will prefer gold over GSEC and cash. So, cash will not be preferred mode of SLR maintenance because cash is not going to generate interest. So, even when this is the most liquid asset that you have, now you know that banks will not prefer cash. Now banks may prefer gold, okay, because gold is not going to lose its sheen or glitter anytime, and this will always be in demand. So that is something that can incentivize the banks, can motivate the banks to amass or to maintain uh, and to use for meeting the SLR requirement. But if that is so, don't you think that this is going to increase the demand of gold in the system, and a very minute proportion of the domestic demand in India, demand of gold, is met by domestic production. So it is mainly through import that we meet the domestic demand of gold, and that is something which is becoming very much problematic for the balance of payment of India. Okay, so increase demand for gold is going to increase the import bill, is going to disturb the balance of payment against India. Okay, so in order to avoid this kind of situation, in order to de-incentivize the banks to go after gold for maintaining the SLR requirement in form of this liquid assets, this gold has to be valued at historical value. So it is going to be valued at some historical price. So historical price, so that is kind of pegged price. So even when is increase in the prices of gold, then the gold that has been kept aside for SLR requirement is not their price. That's price. The price of that particular gold is not going to increase. So in a way that de-incentivizes the banks to amass gold to meet the SLR requirement. So banks will not prefer cash. Banks will not prefer gold. Okay. The question is that if SLR is increased from 18 to 20%, you are an SBI bank and you are maintaining 18% of SLR in cash, gold, and GSEC. And now SLR requirement is increased. You as an SBI bank will increase which particular asset to meet this increased requirement of SLR? That is the question that we are trying to answer. So you just came to know that you won't prefer cash because increased amount of cash is not going to generate any interest. Moreover, there will be opportunity cost involved there. You might be tempted to amass gold, but gold is something which is again going to be valued at historical price, and that again is going to de-incentivize you to increase the gold holding. Okay, so that has been done just to avoid the situation whereby banks may be motivated to amass more gold to meet the increased requirement of SLR. So what they have now, they will prefer government security. Yes. So you are SBI bank and now the SLR requirement is increased from 18 to 20%. Then you will not increase your cash holding, you will not increase your gold holding, you will increase your GSEC holding, that is government security holding, because government security is going to earn you interest. Yes, getting it or not? So if there is increase in SLR, that means banks are going to buy government security. Don't you think so? Yes? Increase in SLR, in a way, don't you think, puts a compulsion, kind of compulsion over banks to increase their GSEC holding, because if they are increasing their cash holding, that is not going to give them any return. If they are increasing their gold holding, that again is not going to give them any return, because that has to be measured or valued at historical price. So even if there is increase in the price of gold, that is something that is not going to benefit them. But government security is something that which very negotiable instrument that can be bought and sold. At the same time, it is going to generate interest also. Okay, so increase in SLR requirement puts a kind of compulsion over banks to increase their government security holding. Okay, they will increase their governments, they will meet their increased SLR requirement only by purchasing more government security. Okay, now the question is, if again there is decrease in SLR from 20% to 18%, okay, so you as an SBI bank will do what? You will decrease which particular liquid asset? You might say that you are going to decrease cash because cash is not going to give you any return. At the same time, there is opportunity cost. But remember, this again is the most minimum amount that you are going to maintain when there was SLR. So you can't further decrease the cash, because cash as a component of many of the liquid assets, as one of the liquid assets, has to be maintained for SLR. So it is the already the minimum amount that you are maintaining. Now, if there is decrease in SLR, again, you cannot just go on decreasing it, because already that is minimum. Okay, similarly, gold, again, because it is being valued at historic price, you are just maintaining just the minimum amount of gold. Okay, so although you may be tempted to answer that if there is decrease in SLR requirement, you are going to decrease cash and gold holding, but that will not be the case, because that is already the minimum level of cash or the minimum level of gold holding that you are maintaining for meeting the SLR requirement. So again, if there is decrease in SLR, that would mean what? You are going to decrease the government security. Okay. So if there is increase in SLR, banks are going to buy government security to meet that increased SLR requirement. And if there is decrease in SLR, then again bank is going to sell the government security to meet this decreased SLR requirement. Okay. So in that sense, increase and decrease in SLR is nothing but kind of compulsion over banks to buy or sell the government security. Buy or sell the government security. Okay, getting it? So this is the case. So this is something that you need to understand. So movements in SLR, upward or low, upward or downward movement, will actually be the change in government security holding, G6 holding. Okay, because if there is increase in SLR, banks are going to purchase more security, government security. If there is decrease in SLR, bank is going to sell those government securities. Also remember that these government security must be unencumbered. Unencumbered security is that security which has not been pledged against any loan. So because it is an instrument, for example, you have a government security with you, then you can just pledge it against any loan that can act as a collateral. Okay, so you can raise loan on that particular asset, because government security is an asset, so you can use it as a collateral. But here, the government security which has to be kept for meeting the requirement of SLR should be unencumbered, should not be pledged. That means no loan should be raised on this particular security, on this particular asset. Okay, so only that kind of government security will be considered for SLR requirement. For SLR requirement. Okay, getting it? So if this is the case, now this again is the trivial information that earlier the limit was 25 to 40%. Now it has been increased from 0 to, it has been changed from this particular amendment that is has been carried out in the year 2006. It has been changed from 25 to 40%, now has become 0 to 40%. Nowadays it stands around 18%. Okay, so that is not relevant from UPSC's prelims point of view, but this concept is relevant. This concept is relevant. Okay, now this is what is happening when central bank changes the SLR rate, statutory liquidity ratio. Then you can now easily understand that what is the objective of SLR, objective of SLR. Okay, so to ensure adequate liquidity in the banks, that means banks must have that amount of cash, means banks will be more and more tempted to give the largest proportion possible of their NDTL for lending. Okay, so it may happen that they are not left with any cash at all, so that those who maintain their deposits or savings accounts with the banks are not able to withdraw the money whenever they need it. So just to ensure that banks had at least that much of rupee, that much of cash, that the withdrawal demands of their depositors could be met. So that becomes one of the very important objective, because a part of SLR is to be kept in form of cash, and that is going to take care, that is going to ensure that the withdrawal requirements, the withdrawal demands of the depositors is met. Okay, the second is to compel banks to lend to the government. Very important, to compel banks to lend to the government. Okay, so for example, SLR is increased because now you have followed, if you have followed the discussion, that would mean what? Banks will be buying more government security. Now, if banks are buying more government security, that means what? don't you think government security, if you're buying government security, it is a kind of loan to the government? A government security with face value of 100, with maturity period 1 year. That means what? If you are buying it at 90 rupees, then you are going to take 100 rupees from the government after 1 year, that is after maturity period. So you have given government 90 rupees in exchange of government security, and now after 1 year, you will again go to the government with that government security, and government is going to give you 100 rupees. So don't you think the 90 rupees that you paid for government security is a kind of loan only that you have given to the government? Because now after 1 year, government is giving 100 rupees back to you, and 10 rupees kind of interest that you have earned on 90 rupees that you gave to the government. Okay, so government security, buying of government security is a kind of lending to the government. Okay, and now you know that if there is increase in SLR, then banks are going to compulsorily, necessarily going to increase their government security holding only. So increase in SLR is going to compel banks to buy government security. That means it is going to compel banks to lend to the government. Okay. Next objective, to develop a secondary market of government securities. The secondary market in government securities, or secondary market of government securities. Okay, that means what? If SLR is increased, then banks are going to buy government security. Now, if SLR is decreased, you again understand that banks are going to sell government securities. Now, this selling of government security by the banks will happen in secondary market. Okay, so that is something that that you study in financial market chapter. But when there is an interaction between the issuer of security and the subscriber of security, that will happen in primary market. But once the security has already been issued and now it is being bought and sold among the investors, among the buyers and sellers, that is something which happens in the secondary market. So when banks are going to sell the government security to meet the decreased SLR requirement, then that buying and selling is going to happen in the secondary market. So in that way, secondary market of government security gets created. Okay. And lastly, to control credit. Okay, if SLR is increased, don't you think that is going to decrease the amount or the proportion of NDTL with banks that is ready for lending? Okay, if SLR requirement is increased, that means now banks have to increase the proportion of the NDTL that they have to maintain with themselves. That is going to decrease the proportion of NDTL that banks have for lending. Okay, so lesser proportion of NDTL will now be available with bank for lending. That means lesser credit in the system. Okay, lesser credit in the economy. Okay, so if central bank has to increase the availability of credit in the economy, then it is going to decrease SLR. And if it has to decrease the availability of credit in the economy, then it will increase the SLR. How? This is directly related with small m, that is money multiplier. Okay, that is the credit creation capacity of the banks. So value of money multiplier will depend upon the credit creation capacity of the banks. That is something that we have understood in the previous part. And if SLR is increased, that means what? A small m will decrease. Credit creation capacity of the banks will decrease. That is going to decrease the money supply in the economy, is going to decrease the availability of credit in the economy. That means now money will be available at higher cost. Okay, credit creation capacity of the bank is decreased, then the credit will be available at higher cost. Okay, so that is something that you need to understand. If MS is decreased, then the aggregate demand in the economy will decrease. That is going to bring down the level of inflation, but will also bring down the economic growth. Okay, that is something that you need to understand. Okay, reverse will happen if SLR is decreased. That means credit creation capacity of the banks will increase the money supply, will increase the availability of credit, will decrease the cost of credit, again will increase the aggregate demand, is going to promote growth, but maybe inflationary. Okay, so that is the chain that you need to understand. Now let us attempt a very important question, a very good question that appeared in the year 2014. Okay, let us see that. Okay, so as we have seen the objectives, now we can attempt the question. Very good question. Okay, let us attempt this question now. So, in the context of Indian economy, which of the following are the purpose or the purposes of statutory reserve requirement? Statutory reserve requirement again is reserve requirement that have to be maintained by banks in statutory accounts. So that is the same thing that we have just covered. So SLR is a kind of statutory requirement only. Okay. Now, what is the purpose of statutory requirement? Here you can say SLR. What is the purpose of SLR? In the context of Indian economy, which of the following are the purpose of SLR? Just consider this question. Okay. The first is to enable the central bank to control the amount of advances the banks can create. Advances means loans. Okay. So yes, if SLR is increased, that means that there will be increase in the proportion of the NDTL that has to be kept aside, has to be maintained with banks with themselves, and that will not be available for lending. So if SLR is increased, then the amount of loans that the banks can create will decrease. Okay, so yes, that is something that is definitely the purpose of such statutory requirements. Okay, such statutory requirements. So yes, this is correct. This first option is correct. The second is the most tricky. So actually, uh, a large number of candidates committed mistake in the second option. This appeared in the 2014. This can be asked. The question can be asked again. Okay, so they can frame it again in different language. So focus here. To make the people's deposit with banks safe and liquid. Okay, read it again. To make the people's deposits with banks safe and liquid. Okay, most probably, I think if you haven't paid full attention, you may say that yes, this is again one of the requirement, one of the purpose of statutory requirement, for example SLR. But I will remind you that when I said that what are the objectives of SLR, I said that one objective is to ensure that the depositors are able to meet with their withdrawal demands. I did not say that it is going to ensure the safety of the deposits. That is a different issue. Okay, ensuring that the depositors are able to meet their withdrawal requirements and ensuring that all their deposits are safe. That means the bank itself is safe. These two are completely different things. Okay, so if you haven't focused well and you are not able to understand the second statement well, then you may commit mistake here. To make the people's deposit with banks safe and liquid. That is not the purpose of SLR. That is not the purpose of statutory reserve requirements. And that cannot be the purpose of statutory reserve requirements because that is not possible if you just see the number here. So, what is the exam? What is actually the SLR here in India? 18%. So, 18% of NDTL. Now, let us see that if SBI is maintaining 100 rupees of total NDTL, and 18% is SLR, then don't you think SBI just have to maintain 18 rupees in form of cash, gold, and government security, and that is something that it will not be lending to the public. Okay, now that 18 rupees out of 100, don't you think is a very small fraction? So that is not ensuring that all the deposits, that is whole 100 rupees safe with bank. No, it can fail. Getting it? So SLR per se cannot ensure that the deposits of all the individuals all the depositors will be safe with the banks. Okay, that is not something that can be ensured by these statutory reserve requirements. Okay, for that we have Basel norms. Okay, Basel norms. So that actually employs the concept of capital adequacy ratio, or CRAR, capital to risk weighted asset ratio. That is something which ensures that banks do not fail. That is, the deposits of bank are deposits of the depositors, people's deposit with bank is safe. So that is something which cannot be, that purpose cannot be fulfilled by statutory reserve requirement, and that is why second option is incorrect. Second option is incorrect, and there most of the candidates made the mistake here. Okay, uh, the first statement is correct. Yes, that is the purpose. The second statement is not correct. Okay, so you can just eliminate option C and option D here. Now you have to choose option C, option D, and option B is also eliminated. Okay, so that way you can conclude that A is the answer, but you can read third statement also: to prevent the commercial banks from making excessive profits. Now, their profit is not contingent upon statutory reserve requirement. So SLR as a concept is not related with the profits of the banks. Okay, because profit is mainly the margin, the net margin that they earn of the interest that they offer on their deposits and the interest that banks earn on their loans. So that actually the major proportion of the profits that back bank make is the margin that they are able to earn. Okay, so that is in no way related to statutory reserve requirement. And the force is to force the banks to have sufficient vault cash to meet their day-to-day requirements. No, not to meet their day-to-day requirements, but to meet the withdrawal demands of the depositors. Okay, so fourth is also incorrect. Only one is the correct option. So option A is the correct alternative here. Okay, so CRR was easy to understand, but SLR was slightly tricky, and that made the very question slightly tricky. Okay, getting it? So I think this is clear now. Okay, keep these things in mind when you are going to attempt prelims. Keep these things in mind. Sometimes UPSC makes very tricky questions also. Okay, so most of the candidates that I have seen committed this mistake, that they opted for B alternative, and that was the incorrect alternative here. Okay. Next instrument, quantitative instrument, is open market operations. So this is quite easy to understand, but you have to understand the related things here. Okay, so under open market operations, what central bank does, it buys and sells the government securities. Okay, to influence the money supply in the economy. So for example, if this is the government security, if central bank is buying the government security from the market, that means central bank will pay money and will take government security. So money will go to the market. Okay. Now, if more money is going to the market and this paper, government security, is coming to central bank, then that is going to lead to the increase in money supply. Getting it? Getting it? Now, if central bank is selling G6, that is government security, that means in that case, what will happen? Government security will go to the market and money will come from market to central bank. So in that sense, that is going to decrease the money supply in the economy. Okay, so if central bank is buying government security, then I'm sorry, if central bank is going to buy the government security, then that is going to decrease the money supply. If central bank is going to sell the government security, then that is going to decrease the money supply. If central bank is buying the government security, that is going to increase the money supply. Okay, so this is what we know as open market operation. But understand one related concept here. Okay, so for example, this you can understand it this way. This is the government security with face value of 100 rupee, maturity period 1 year. That means if you buy this government security, this at this moment, at whatever price you are willing to pay for this particular government security, then government will give you 100 rupees when you will go to the government with this paper after 1 year. Okay, so suppose you bought it at 90 rupees today, then after 1 year, that is after this maturity period, government will give you 100 rupee. So that is called the face value. Now this government security is going to be sold in the market in auction. Okay, so different institutions, different um, bodies are going to make bids on it. Okay, so for example, there is SBI bank, which is going to, which is ready to buy it at say 90 rupees. Okay, 90 rupees. So SBI made the bid here at 90 rupees, but SDFC is going to, or is ready to buy it at 91 rupee. Okay, then ICICI is ready to buy it at 92 rupees. Understand what is happening? If SBI is buying it at 90 rupee, that means what? SBI will give 90 rupees to the government, will take this security, and after 1 year, SBI will go to the government and will ask for, government will give 100 rupees. That is after 1 year, that is after maturity period. But if SDFC buys it, then SDFC pays 91 rupees to the government, and after 1 year is paid 100 rupees back. Okay, similarly, ICICI can buy it at 92 rupees and will get 100 rupees back. So don't you think SBI, if SBI is able to buy this government security at 9 rupees, then it will be making 10 rupees of profit after 1 year. So that you can call the interest that it earned in 1 year. But what the interest SDFC earned in 1 year? 9 rupees, because SDFC bought it at 91 rupees. And the interest earned by ICICI, if it bought this government security at 92 rupees, is 8 rupees. Okay, so what is happening if you move from here to here? Price is increasing. Price is increasing. Yes? Price is increasing. Now, don't you think that if government is auctioning this security, there's this government security to the market, in the market, then government will sell this particular security not to the SBI but to ICICI, because ICICI is ready to buy it at 92 rupees. So why the government will give it to SBI? No, government will try to sell it at the highest price possible, because government is selling it, getting it. So it is going to the RBI. RBI is going to sell it on behalf of government. Okay, so it will be sold to ICICI. Okay, so from here, from SBI to ICICI, price is increasing. Price is increasing, but the interest is decreasing. Okay, so interest rate is decreasing. Here, the total interest that was earned was 10 rupees. Least price was 90 rupees, and the total interest was 10 rupees. That is highest interest. Here, the price is 91, but interest became 9 rupee. Here the price is 92 rupees, but the interest came down to 8 rupees. So highest price, least interest. So bond price, you can say, is inversely proportional to interest rate. Bond price is inversely proportional to interest rate. So that is something that you have to remember as a rule in the economics. Okay. One may ask that how the interest rate of this particular government security is deciding the interest rate of the economy. So you must remember that the interest rate of government security is one of the most determining determining interest rate or decisive interest rate, because many things are anchored on the interest that is offered on government security. Okay. So if bond price is increasing in the economy, the interest rate is going to decrease. Okay, so there can be a question on this particular concept also. So that is something that you need to understand. Okay. So if interest rate is increasing, then bond price must be decreasing. Okay, bond price must be decreasing. So this way you have to remember it, and then you will be able to answer the question if it is being framed on this concept. Okay, so we can move on to the next thing here. This is what we know as open market operation, that is buying and selling of government security. So if government security is sold in the market, that means government security will go to the market and money will be sucked out of the system. That means there is going to be decrease in money supply. Okay, decrease in money supply. Understand that increase or decrease in money supply can happen through two different kind of monetary policy. One is called expansionary monetary policy, and the other is called contractionary monetary policy. Contractionary monetary policy. Okay, although that will come later, but I'm going to use these terms, and that is why you need to understand. Expansionary monetary policy is going to increase the money supply in the economy, and contractionary monetary policy is going to decrease the money supply in the economy. Okay, expansionary monetary policy will be such where credit creation capacity of the banks will increase. So credit will be available at lower cost. So you can say money will be cheaply available. So you can say here it is also called cheap money policy. Cheap money policy, because money is cheaply available here. Okay. While contractionary policy, monetary policy will be such where credit creation capacity of the banks is going to be decreased, and that is why credit will be available in contractionary monetary policy at higher cost. So money will become more dear, it will not be cheap. So that is why it is called dear money policy. Dear money policy. Okay, dear money policy. So contractionary monetary policy is dear money policy. Okay, money supply is going to decrease here. So the objective of contractionary monetary policy is to decrease the money supply in the economy. So that is also called hawkish monetary policy. So whenever it is said that central bank is becoming hawkish, that would mean what? Central bank is using the monetary policy measures, that is instruments, to decrease the money supply in the market. Okay, to decrease the money supply in the economy. So that is also called hawkish monetary policy. Hawkish monetary policy. And this expansionary monetary policy is called dovish monetary policy. Dovish, dovish and hawkish. Okay. Now the objective of expansionary monetary policy is to increase the money supply in the market. That means what? This monetary policy will be adopted to promote economic growth. Yes, to promote economic growth. Yes, this may be inflationary in nature, because that is going to increase the price. That may lead to increase in the price level. Okay, because expansionary monetary policy is going to increase the money supply in the economy, is going to increase the aggregate demand. That means that can result only when there is increase in purchasing power, but that may also increase the price level. While contractionary monetary policy, also called hawkish monetary policy, also called dear money policy, is going to decrease the money supply in the economy, and that is why its objective will be to contain the inflation or to stabilize the prices, the price level. Okay, so this you need to understand. Again, come back to this. So central bank will be using open market operations depending upon the different objectives that can be set for monetary policy to achieve. Okay. Next is bank rate. So let us understand bank rate now. Okay. So what we are doing the quantitative measures that can be adopted for monetary policy. Okay. So the first thing that in bank rate you have to remember that it is the rate at which banks are going to borrow from RBI. But every borrowing activity that will be undertaken by banks when they are borrowing from RBI will require certain kind of collateral. So you will come to know about other tools of monetary policy also that are adopted and that are actually used by the central bank. And the same tools are actually also used by the banks when they go for borrowing from the RBI. But one such tool is bank rate. So what you have to keep in mind that it is that rate of interest which central bank applies on banks when banks go for borrowing from RBI. But you have to keep in mind that what kind of collateral is used. Okay, so what collateral banks offer when they are going to borrow from RBI under bank rate. Okay, as a tool. So it is the rate of interest at which central bank lends, or you can say banks borrow from central bank, lends to banks against corporate security. So the collateral here is what? Corporate securities. Okay. Now corporate security, what is corporate security? That is something that you will come to know. But the same thing can be, same definition can be reframed as follows. It is the rate of interest. Bank rate is the rate of interest at which RBI provides RBI provides rediscounting facility. Rediscounting facility to commercial banks against their first class securities, so the same definition, it is the rate of interest at which central bank lends to banks against their corporate security. The collateral here is corporate security, not the government security. Okay, but how this is happening? The rate at which the central bank is going to rediscount, I'm going to explain this thing through an illustration here, is going to rediscount, not discount, rediscount against their first class securities. So here the first class securities, that is the corporate securities. First class securities are those securities which can be offered by the banks to central banks to avail loan under bank rate. Okay, so this is written here. First class securities are corporate securities against which banks can borrow from RBI. For example, commercial paper, commercial bill, or certificate of deposits. Okay, so what are first class securities against which banks can borrow from RBI under bank rate? So these first class securities are actually corporate securities. Now these corporate securities are rediscounted by central bank. The rate at which they are going to be rediscounted is the bank rate. Okay, so what is the meaning of rediscounting here? That is something that you have to understand. Corporate security. So for example, there is commercial paper. One such corporate security is commercial paper or commercial bill. And what is commercial paper? Unsecured security. Unsecured security which is issued by high net worth company. So इसका एक maturity period होता है. This is the window here, 14 days to 1 year. Minimum value is 25 lakh rupees. Okay, so these are high value unsecured, that is they are not being backed by any particular asset. Okay, that is what we mean by unsecured security, and that are issued by high net worth companies. Okay, and these kind of securities are going to be rediscounted by central bank when banks are borrowing or central bank is lending to those banks. So the collateral that banks are going to offer to the central bank is corporate security, it is not government security. These are first class securities which are going to be rediscounted by central bank. Okay, understand? So for example, there is TCS, or you can say any corporate, for example, Tata Motors. Okay, Tata Motors. Now, Tata Motors issued its security of worth 25 lakh rupees with maturity period of 6 months. can be from 14 days to a year. Okay. So Tata issued this particular security to SBI, and SBI discounted it. That is, it as Tata Motors issued this 25 lakh rupees worth of security to SBI at a discount, at a 10% discount, say. So SBI bought this unsecured security issued by Tata Motors. This is a commercial paper, the typical working how this commercial paper is transacted. Okay, the transaction of commercial paper takes place. This is how, this is typically how this is done. So it is being discounted, or it is being sold to SBI at a discount of 10%. So SBI will buy it at say 22.5 lakh rupees. Getting it? So SBI gave 22.5 lakh rupees to Tata, and Tata sold it at 25 lakh. Okay, 22.5 lakh rupees. So what Tata will get at this transaction? From this transaction, Tata will get 22.5 lakh rupees. What SBI will get after 6 months, it can go to Tata with this commercial paper and can demand 25 lakh rupees, because this is the maturity period. Okay, so this is the example of corporate security. Now this corporate security in the meantime is with SBI. SBI can go to central bank, that is RBI. Okay, can put this government security here, this corporate security, I'm sorry, here, and can get it rediscounted, can get it, it has been discounted again here, can get it rediscounted by RBI. Man, that means RBI will be buying it from SBI, and when SBI is going to sell it to RBI to raise the loan here, then RBI is kind of rediscounting the same security which has been discounted at this stage. Okay, so SBI is again going to ask RBI to lend certain money against this corporate security which has been discounted at this stage, but is being discounted again, or will be discounted again at this stage, and the rate at which this is going to be discounted is the bank rate. Okay, bank rate. Now that security will go to RBI, and RBI will give money. Then SBI can again claim that security after repaying that amount, and then will come to Tata to reclaim 25 lakh rupees after the maturity period. So the security, corporate security, which has been discounted once, is going to be discounted again, and that is why it is said that it is a rediscounting facility. If you go to the definition, it is a rediscounting facility. Now it is a first class security. So this is the corporate security that is being used by SBI to borrow money from RBI. The rate at which this first class security, first class corporate unsecured security, that means a security which is not backed by any collateral apart from the worth that this Tata Motors, the credit that this Tata Motors has in the market, there is no other collateral, no other asset which is backing the security. That is why it is being called unsecured security, is being rediscounted again at this stage. And this rediscounting will happen at this rate, that is the bank rate. So that also becomes the rate at which RBI is lending money to SBI against its first class corporate security. Okay, so that is bank rate. So you understood that how bank rate is the rate at which central bank gives loans to the banks, but what is the collateral used, that is also something you understood, and how this transaction takes place, how those corporate securities which are acting as collateral here are going to be rediscounted. So that rediscounting rate is going to be the bank rate here. Okay. So did you understand bank rate? Now, if bank rate is going to increase, that means what? If bank rate increases, then the rate at which that corporate security, which is acting as a collateral against which banks are able to borrow money from RBI, is going to increase. So, if bank rate increases, then the cost of credit for banks become higher. It increases. That means what? Now, banks will also be able to lend money to the public at higher cost. So, the cost of credit will become higher. Okay. You can also say that if bank rate is increasing, that is going to decrease the credit creation capacity of the banks. Okay. So if bank rate increases, that is going to decrease the small m, that is the credit creation capacity of the banks will decrease. That is going to decrease the money supply. It is going to decrease the aggregate demand, decrease the economic growth, also decrease the price level. Getting it? And reverse will happen if bank rate decreases. That is going to increase the small m, that is the credit creation capacity of the banks will increase, money supply will increase, aggregate demand will increase, economic growth will increase, inflation will also increase. Okay? Now, if you have understood the concept of bank rate, let us see this question. The lowering of bank rate by Reserve Bank of India leads to बैंक रेट अगर डिक्रीज कर रहा है, so if there is decrease in bank rate, small m will decrease, money supply will decrease. Okay, can you relate it? More liquidity in the market. If lowering of bank rate means, I'm sorry, if bank rate is decreasing, small m will increase. Yes, credit creation capacity will increase, money supply will increase. Okay, that's my bad. You just committed a mistake here. If you have followed the discussion, you have seen that if bank rate is increasing, then small m is decreasing. So if bank rate is decreasing, then small m will decrease. So decrease in bank rate is going to increase the small m. Lowering of bank rate is going to increase the small m. That is, credit creation capacity of the banks will increase. That means money supply will increase. Money supply will increase. So money supply is also called the liquidity of the system. Okay. So we have covered that in previous parts on the discussion. So more liquidity in the market. Yes, that is correct. Less liquidity in the market. No. Lowering of bank rate would mean more liquidity in the market. No change in the liquidity. No, there will be a change in the liquidity. Liquidity will increase. Mobilization of more deposits by commercial banks. That is something which may or may not happen. Okay, so that is not directly related with this bank rate here. Okay, getting it? So again, this was a direct question. Let us see this question. When the Reserve Bank of India reduces the statutory liquidity ratio, that is SLR, by 50 basis points, 50 basis points, which of the following is likely to happen? Okay, so you have studied about SLR. The only new thing that this question has is 50 basis points. So 1 percentage point equal to 100 basis points. Okay, so 50 basis points would mean half percentage point. Okay, so 0.5% has decreased. So SLR, say for example, it is 18%. Now it has decreased from 18, it has become 17.5. Which of the following is likely to happen? So if SLR is decreased, what will be the effect on small m? That is something that you have to know. Okay, so small m will depend upon, or money multiplier is going to decide credit creation capacity of the banks. If SLR is decreasing, credit creation capacity of the bank will increase, that is small m will increase. That means money supply in the economy will increase, liquidity in the system will increase, and this is how you can decide. Now India's GDP's growth rate increases drastically So there is only half percentage change in SLR. Now how it can bring drastic changes. Okay, so the option is actually very extreme. So that does not conceptually fit the scheme of the things here. Okay, that is not the correct, that doesn't seem to be a correct alternative, but we will analyze by keeping the other alternative, by analyzing the other alternatives also. Next is foreign institutional investors may bring more capital into our country. Foreign institutional investors, so they are attracted towards your economy. When your economy is very attractive, it is booming, so there is high economic growth. Okay, um, that is something which is the result of so many factors, but that may or may not happen just because of change in SLR. Okay, so change in SLR is not going to make the whole economy attractive to the extent that it starts attracting the foreign investors, institutional investors. Then the scheduled commercial banks may cut their lending rates. Let us see this. SLR requirement has decreased. That is, the credit creation capacity of the banks has increased. That means MS has increased. That means money is cheaply available. That is, credit creation is easier. That means the cost of credit is becoming low. That means the lending rates will also be low by the banks. So this seems to be the correct option here. Scheduled commercial banks means those banks which are listed in Schedule 2nd of the RBI Act. So those are scheduled commercial banks, simply banks you can say. Scheduled commercial banks may cut their lending rates. That means they can decrease their lending rates because credit is available at lower cost because of increased money supply. Okay, so now the larger portion of NDTL is available with banks for lending. That means now it will be easier for banks to lend money. Okay, now if it is easier, that can be done at lower cost. That means they will be ready, or they will be willing to cut their lending rates. So this is actually the correct alternative here. Okay, let us see this. It may drastically reduce the liquidity uh, to the banking system. SLR is decreasing, that is going to increase the liquidity in the system, and it is not going to decrease the liquidity in the system. So this is also incorrect. A is incorrect, B is incorrect, and C is the correct option. Okay, so see how you can easily connect the things here if you have understood the concepts very well. Okay, so we will continue discussing the other questions and the concepts also.